Welcome back to our intermediate accounting class. In our last few segments, we were focused on GAAP and the Financial Accounting Standards Board that sets GAAP and the conceptual framework that FASB uses as the foundation for those new rules. Now that we've reviewed the basics of GAAP itself, it's time to move on with our conversation about the accounting cycle as part of our review of earlier material and talk about the full accounting cycle. So we're going to start with a discussion of the accounting equations. We'll talk about journal entries. Yes, the best part. We'll talk about trial balances. We'll talk about converting from cash to accruals. And we'll briefly talk about the financial statements and how they fit in to our overall discussion, but we'll get to them in a lot more detail in future chapters. So that's where we are. Let's talk about why this accounting cycle stuff is so very important to us in accounting. There's a lot of different reasons why this is essential. Some of them we talked about as we talked about the conceptual framework. But just to review, first off, remember that these basics, the accounting basics that form the accounting cycle, are the foundation of all accounting. This is the bookkeeping stuff that goes into our bookkeeping warehouse that we talked about before. We need this. All accounting comes back to these basics. Whether you're doing tax, cost, financial, doesn't matter. Everything comes back to the basics that we have in this bookkeeping process. Now, in addition to just understanding the basics of bookkeeping because it's the foundation, you need to be at least conversant with the language of business because we use it for so many things. And here are some of them. We provide information to external stakeholders. We use it to evaluate performance, both of the firm as a whole, of our competitors, of our managers, and were they able to meet their goals. We also use it to make internal decisions as part of the process of deciding what costs we need to try to cut, as part of deciding what it costs us to produce units, a part of variance analysis, budgeting. All the different parts of cost accounting also come back to the information that we gather during the bookkeeping process. Now, if you're an accountant, that's important because you'll be gathering this data. If you're not an accountant, you'll still be using it. You need to be conversant in this language, at least the basics, so that people know that you know what you're talking about, right? I mean, if you don't understand what earnings per share is or what a journal entry is, you're not going to look very smart at the next board meeting. The last thing I'll say, and then we'll move on to doing some of this stuff, it's important to understand this so that your accountant doesn't rob you blind, right? If you don't know what he or she is doing, it's easy to sneak things away. I have to tell you a story right here. I probably shouldn't take time for it, but the other day I came home from work and found all these bags all over the floor. My wife apparently had gone out after a holiday. It was Halloween, and she'd got a bunch of decorations and costumes for next year and all this stuff. And I looked at her and said, "What is all this?" And she said, "Well, it's Halloween stuff. I saved a lot of money. It's going to be great." And I said, "That's wonderful, but we don't have a budget for all of this." And she looked at me and she just said, "Well, you're the accountant. You figure it out." So there is some of that pressure, right, where we just kind of put things on the accountants and we just trust them to figure it out somehow. And if we're not monitoring, if we don't know what they're doing, who knows what they're doing? For all my wife knows, I took her flower budget for the last 6 months to pay for all of that. I didn't, for the record, I didn't. But I could have, because she wasn't paying attention. I was just supposed to figure it out. So that's why this stuff is important that we're about to talk about, because it does form this foundation. It gives us this language. It makes us conversant, and we use it for all these different aspects. With that said, let's jump into our discussion of the accounting cycle itself. And here are the different steps to the accounting cycle. Now, we could walk through each of these steps and discuss them, but I think it would be much better if I drew you a picture. So let's go ahead and draw a picture of the accounting cycle. So the very first thing, first part of the accounting cycle, is going back through and deciding what needs to be recorded. We call this process identifying. And in most cases, it's pretty easy to identify what it is we need to keep track of. Not always, but usually. Once we've identified transactions, then the next thing we do is we make the journal entries. And if you remember, we drew a truck driving up to our bookkeeping warehouse. Let's see, we had one way down at the bottom, we had one about midway. These are our different windows that we talked about. So this is step 2. It's making the journal entries. My favorite part, honestly. I can't wait to get to these. But It's taking all of these transactions and putting them, that we've identified in step 1, and putting them into the journal and making those entries. Step 3, the next thing we do, is we're going to post the journal entries. So we take our journal, where we've carefully kept track of everything, and we move it into our ledger. And we don't really use T accounts as our ledger, but that's how we usually represent them in classes, so we'll go ahead and stick with that. But this is the process of posting, moving the journal entries into the ledger. All right, after we finished posting, the next thing we do is create a trial balance. And I'm going to create a big picture here so I can fit everything in. So this is our trial balance. And in the trial balance, we're going to list all of our accounts. And then we're going to list debit balances in one column and credit balances in another column. And hopefully they line up. So this is step 4, and it's creating the trial balance. And the idea is we're going to check and make sure that our debits and our credits are equal from all the different journal entries and the posting that we've done. So from all of these ledger accounts up here, we're going to go through and add up and get an ending balance for each one and put that down into our trial balance. That's our next step. Once we've got a trial balance, then the next step is to create our adjusting entries. So let's bring back our little guy here, because the biggest part of coming up with adjusting entries is deciding what adjusting entries we need to create. And once we know, then we can put them in the journal. And it's always a happy occasion when we figure out what needs to go in our adjusting entries. So this is step 5, making our adjusting entries. Okay, after making our adjusting entries, then we create a new trial balance. This is an adjusted trial balance. So again, we list out all of our accounts. Usually there's some new ones from these adjusting entries. We list our debits and our credits, and based on what we've done in the adjusting entries, hopefully it still balances. So step number 6 is an adjusted trial balance. Once we're going to adjust the trial balance, our next step is to create the financial statements. And if you remember, we drew these out as a window. I'm not going to try to draw them. We'll just abbreviate them here. Income statement, balance sheet, statement of cash flows. There goes PowerPoint being helpful. Statement of retained earnings. And then, of course, we do our footnotes that go along with our financial statements. And this is step 7, is using the information from the adjusted trial balance to create our financial statements. Once we've done our financial statements and everything balances and looks good, then we move on to step 8, and that is to make our closing entries. And I thought really long and hard about what our picture should be here, and I finally decided that the best way to do it is with a car. Pretend that's a car. Because what we're doing is we're moving everything forward and cleaning it up. So I don't know that the card's the best image you could possibly think of for that, but it was the one that made sense to me, so that's what we're going to use. So this is step number 8, and it's the closing entries. And you probably have noticed a pattern here. Every time we do journal entries, then the next thing we do is we do a trial balance, and it's the same here. We now do a post-closing trial balance. And again, we have our accounts, we have our debits, our credits, and hopefully everything balances out. And this is our final check to make sure that everything we've done balances. And now with everything closed and a balance done, then we're ready to wrap things up. Now this is the normal accounting cycle. All the different steps, 9 different steps. Oops, I forgot to write this one in. This is our post-closing trial balance. You will sometimes see one more step added to this. And I'll just draw it in. A lot of companies don't do it anymore, but they used to. Right in here, they used to do what they called reversing entries. We're going backwards with our truck now. Reversing entries, again, we don't do them very often with computer systems. It used to be you'd make all these adjusting entries, and then because you had just a basic bookkeeper or a computer system that did batch processing, that you would then reverse all of your adjusting entries. So, for example, you would do a journal entry to record your wages expense during the year, and then you'd reverse it, and you'd simply flip that journal entry and do the exact opposite at the beginning of the next year, so that when you did your next batch entry, or your accounting clerk or whoever it was, your bookkeeper, that didn't really know what was going on, did a batch entry later on, it would just flow on through and wouldn't mess up your accounts. So that's what it means to do a reversing entry. Now, this whole idea, all these different steps that make up the accounting cycle, and the fact that each step flows into the next one, is one of our key concepts, because you really have to know that the accounting cycle all goes together and it flows through to keep this system running and running from year to year. And with that key concept, we're going to go ahead and end this segment. I will see you in the next one as we move on with our discussion of the accounting cycle. I'll see you in a few minutes.